Started. Good morning, everyone. Happy New Year. What better way to start the new year than to talk about ACA reporting and IRS penalties? So you're welcome. I see some friendly faces in the room, so it's great to have you folks back who've attended this webinar in the past. This is a focused, targeted webinar that addresses how to complete your annual ACA reporting, Forms 1094C and 1095C, so that you can avoid some of the completely onerous IRS penalties. The reason why we do this webinar is this number right here. $2.1 million. This is the value of proposed IRS ACA assessments that we have seen with our clients over the last several years. And the vast majority of the items that drive these penalties are errors in the ACA reporting. And so because of that, we started this this webinar series several years ago in order to help educate clients on how to self-audit your 1095C forms if they're being produced by third-party vendors like payroll providers, and how to make sure that you can avoid some of these costly errors in the future. The vast majority of these penalties, again, have been the result of errors in reporting produced by third-party vendors that are not being audited by the employers. And I'm not bashing third-party vendors or payroll providers. They provide a fantastic service, but if you're not monitoring what they're doing, there is a potential for them to transmit inaccurate information to the IRS, and we want to avoid that. So today, we're going to cover briefly who files what, the current deadlines for this tax year. I'll update you on penalties and IRS enforcement. We're going to spend most of our time today reviewing the actual 1094 and 1095C forms, and then we'll go through a bit of a coding exercise and look at some examples of properly coded forms and some examples of improperly coded forms. This is a fairly sizable webinar that in past years has been about an hour to an hour and a half. I'll just warn you now that the number of slides has not changed much, but I'm going to do my best to keep our promise of keeping this to about 45 minutes so we have some time for questions at the end. Because of that, that means we're going to be blowing through some of these slides pretty quickly. But as Sarah mentioned, you're going to have this recording, you're going to have the full presentation at the end of today. So please contact me for any questions about stuff I don't specifically go into great detail on. So first, who files what? Most everybody in this room right now for this webinar is a fully insured applicable large employer, which means you're filing forms 1094C and 1095C. You are not completing part 3 of the form. We'll talk about what that part is and how that applies to strictly self-insured employers, which I don't believe anybody in this room is that case. Just a reminder, we still have a health insurance mandate in the state of California. If you're a resident of California, you are required to have health care. If you don't, the Franchise Tax Board penalizes you when you file your taxes. We talk about this because the Franchise Tax Board also wants 1095C data. However, they get that data either from self-insured employers directly, or they get it from the insurance carrier if you are fully insured. So if you have a fully insured medical plan, you don't have to worry about filing this data. They're going to get it from your insurance carrier. I do want to point out this, though. There is a conflict between the deadline for 1095Cs according to the state versus federal. In the state publications about this mandate, they state that that employees should be provided their 1095s by January 31st. This is in conflict with the federal deadlines. The current federal deadline to get forms to employees is March the 2nd. And this is now a permanent date as of this tax year. So you can mark March the 2nd on your compliance calendars on a go-forward basis. Transmission of everything to the IRS has to occur by February 28th if you're filing by paper, which I don't know that many people do anymore. If you're filing electronically, you have until March 31st to get the information to the IRS. One quick note on the transmission, the IRS will soon require electronic transmission for pretty much everything. There's proposed regs for that. They haven't been finalized yet, but that's coming. If you're filing on paper still, prepare for that to go away very soon. A quick update on penalties. Again, I'm not going to go through all of these. I'm just going to focus on the ones related to the ACA. The A penalty for failure to offer coverage is now up to $27.50 multiplied by the sum total of all of your full-time staff less the first 30. And the B penalty for failure to offer affordable coverage is now $41.20 multiplied by the number of employees that received a premium tax credit to get subsidized coverage on Covered California. What this looks like in practice for a company of 75 full-time employees, for failure to offer coverage, the A penalty is a fine of $123,750. So as you see, these penalties get very large very quickly for minimal mistakes. And again, most of what we've seen to date has been errors in reporting, which I'm hoping to address with this webinar. So another very quick just enforcement update. I talked last year about the Treasury IG report from June of 2020, which was very critical of the IRS in collection efforts for ACA penalties. They noted that the IRS assessed $17 billion in fines, but only collected $759 million. The Inflation Reduction Act of 2022 allocated $80 billion in funding to the IRS, and most of that is going towards enforcement. The other thing that I find of interest is every year the IRS publishes its priority guide of things it wants to focus on for enforcement in the coming tax year. And item number 25 on the current priority guide is ACA reporting. So all of these things taken in combination assure me that the IRS is going to be increasing enforcement efforts on ACA penalties, and we're probably going to see more of these in the coming years. Also, I think I talked about this last year, good faith relief is now gone. So in years past, when employers were getting used to the ACA filing process, the IRS would provide reasonable relief from penalties if you could demonstrate that you at least tried to be compliant and fixed any compliance errors. That's gone now. Not only can you be penalized for not offering coverage and not offering affordable coverage, you can also be penalized for not doing the reporting correctly and not doing the reporting at all. Those penalties are $280 per form, and it's actually a double penalty because the IRS assumes that if you fail to file forms with the IRS, you also fail to provide forms to the employee. And lastly, I think this is lastly, yes. And lastly, there is no statute of limitations for ACA penalties. And the reason for that is because the chief counsel for the IRS has opined that ACA reporting is not tax returns. That means that any tax year after 2014 is fair game for the IRS to go after ACA penalties. So it's critically important to make sure your reporting is timely and accurate, that you're auditing anything that's produced by a third-party vendor or a payroll provider before they transmit. A third-party vendor should not be transmitting anything to the IRS unless you have put eyes on it first. That's critical. Correct any inaccurate information as quickly as you discover it. You got to retain copies of everything yourself for audit and defense purposes as well. Don't rely upon the third-party vendor to retain copies of your reporting. You need to pull all of that stuff down from their portal or their website, save it locally in a way that can be obtained in the future. Don't password protect it. I've had situations where, you know, a particular person in the office is charged with saving this information. They save it to a folder, it's password protected, and now that person doesn't work for you anymore, and you can't get access to the information. Don't do that. And you also want to keep copies of all of your plan information, because you're going to have to prove that your plan offer was affordable by showing what the cost sharing was, and also that your plans met ACA standards. So with that, we're going to throw a couple of poll questions at you this morning. And I think, Sarah, we have our first question ready.
Yeah, do you want to start with the audit of last year's 1095-C?
Yeah, let's do that.
All right.
So last year, did you audit your 1095-C forms before they were transmitted to the IRS? Yes or no? And Sarah, just for my now, when do I see the results?
Yep, I will end it right now. We're just waiting for a couple people, so I'll end it and then I'll share them here.
Got it. Okay. I
Sorry
wasn't sure if I should be seeing that in real time or not. Okay. So this is awesome, 92%. I'm so happy to see that. I hope that's the result of our education to our clients. That's tremendous. And by the end of this morning, hopefully the rest of the 8% of you will understand the importance for this. But that's great to see. Okay. So
we do have another one, Keith, too, if you want to launch the second one.
let's
People have
hold
copies
off
of
on
their
that one
forms.
for just a minute.
Okay.
Yep. Thank you. Okay. So we're going to start off with a review of the 1094-C transmittal form. Here is the form. This form has not changed much in the last several years. That's why we have a 2019 version here. I haven't updated this slide. The first part of the form, part one, this is obviously pretty straightforward. Name of the company, address, your tax ID number. Lines 9 through 16 are not completed. You are not a governmental entity. Line 18, the total number of forms transmitted with this transmittal. Every time you send a 1094 to the IRS with 1095-C forms, you need to indicate how many forms you're transmitting. Question number 19, is this the authoritative transmittal? This is generally checked as yes. The only reason why this would not be checked is if for some reason you have different areas of your company where you want to file your 1095s separately for each area. I don't know anybody that's doing that. I don't know why you would want to do that, but that's the only reason why this box would not be checked. For the vast majority of cases, this box should be checked. Number 20, total number of forms filed by this AOE member. This number is largely always the exact same number as you find on line 18. Question number 21 is a really important question. So question number 21 asks, are you in a controlled group? Aggregated ALE group is another way to say controlled group. If you are part of a number of different entity companies that have different tax ID numbers but with employees, and there's common ownership between those entities, that's a controlled group. Controlled groups have to say yes to this question, and you have to add some additional information to the 1094-C about the other companies that are part of the controlled group. This slide just describes that in a little bit more detail. So the IRS sees controlled group companies as one entity for purposes of compliance. So let's say you have a collection of 3 separate companies that have common ownership. There are compliance obligations for each of those separate companies, but for compliance purposes, for healthcare and other things, the IRS also sees that as one company. That's why it's important to make sure that A, you know if you're in a controlled group or not, and that B, you're completing the 1094-C in a correct way so that the IRS can gather that information. The other question on this section of the form that I get quite often is, what qualifying offer method do we check this box or not? Excuse me. Qualifying offer method is a special kind of medical insurance offer that's largely tied to the cost of coverage to the employee. If the cost of coverage to the employee is less than the Fed poverty earning level for that tax year, applied to the affordability percentage, which for 2022 was 9.61. If the cost of coverage to the employee for employee only coverage is below that level, you can use qualifying offer method. Qualifying offer method allows you to do some substitutive coding on your 1095s, and it's associated with using code 1A on line 14 of the 1095-C. When you use code 1A, you are not required to put any cost information on line 15, and safe harbor information on line 16 is optional. So in many cases, you may have code 1A on line 14 and nothing else on the form, and that's an entirely correct form. We're going to go through and look at these codes in detail when we look at some samples of some actual 1095s. But this is what a qualifying offer method is, and it's what it does with regards to your ACA, excuse me, your ACA filing. If you have questions about whether you should or should not be checking this box, obviously contact me and we can talk through your particular situation to get that answered for you.
Keith, we did have one question come in real quick that I want you to address. They're asking if we had an average of less than 50 full-time employees during 2022, are forms 1095-C and 1094-C required to be filed?
No. So if you had less than 50, so it goes to what is a applicable large employer, which we have a slide actually coming up on this. But if you are not an applicable large employer in the tax year, you are not required to file forms 1095-C, 1094-C. It's only for applicable large employers. Now, if you're close to that 50 mark, I would want to take a careful look at your FTE count. The FTE count is based on a monthly calculation that's averaged over the entire 12-month period of time of the tax year. If you know you're definitely below that, no question, then no, this filing does not apply to you. If you have questions about how to do that FTE calculation, contact me after this and we'll go through that together.
Great, thank you.
Okay, part 3 of the 1094-C on page 2, this column A, this is the single most critical part of the 1094-C that has to be answered correctly. This is the primary driver of ACA penalties for inaccurate reporting. The column is entitled Minimal Essential Coverage Indicator, Yes, No. What the IRS is asking you is they're asking you, did you meet your employer mandate to offer MEC coverage to 95% of your full-time staff, yes or no? If you answer no, you're telling the IRS we did not meet our mandate, and you are guaranteed to be penalized if any of your employees end up at Covered California. It's an absolute guarantee. When you're auditing your 1094-Cs processed by a vendor, you have to check this information to make sure it's accurate and to make sure this says yes across the board. Now, a caveat to that is this. If it's true that you haven't actually offered coverage to 95% of your staff for any particular month, you obviously have to give also accurate information to the IRS. So I'm not suggesting to just blanketly say yes to this question if the information is actually not true. But by and large, if your plan is set up correctly, this should say yes all the way across the board. The other columns are pretty straightforward. Column B is your full-time body count. Column C is your total employee count, full-timers plus part-timers. And column D indicates if you are in a controlled group, which month or months are you in that controlled group. If you're in a controlled group, the last part of the form, you must provide the IRS with the name or names of the other companies that are part of that controlled group and their tax ID numbers. Okay, so that's the 1094-C. Now we're going to take a look at the 1095-C. Again, this form has not changed much over the last several years. They did add a couple of new fields in 2020. We're not going to really talk about them. The employee's age on January 1st and a zip code. This has to do with employees that are receiving certain kinds of HRAs, ICRAs, individual coverage HRAs, which does not apply to anybody on this particular call. The first part of the form, we're going to blow through this, super straightforward, employee name, social, company name, tax ID, super straightforward. Here's what a completed 1095-C would look like. This is an accurate form. We're going to spend the rest of this webinar going through what these codes mean and what the code combinations are and which combinations make sense and which combinations don't make sense. This is a valid form. For the first couple of months, we have 1H, which means no offer of coverage, paired with 2A, which means the employee was not employed. That's entirely valid. You're not going to offer coverage to people that don't work for you. Then in March and April, we have 1H again, no offer of coverage, paired with 2D, which means that the employee is in your waiting period. Completely valid once again. And then this employee is eligible as of May 1st. So now we have an offer code, code 1E, paired with cost of coverage to the employee of 150, and code C, meaning the employee enrolled in coverage. Then in September, there is a change. In this situation, the employer maybe had their renewal in September. The cost of coverage is now a bit higher. The employee has waived coverage, and now we have an affordability safe harbor code, code 2H, which means the employee waived coverage, but the offer of coverage is affordable based upon rate of pay safe harbor. And again, we're going to go through these codes in detail in just a minute here. And then in November, everything changes. It looks like the employee left employment sometime in October. Coverage runs through the end of that month. And then as of November, we have 1H again, no offer of coverage, paired with 2A, the employee is no longer employed. This is information about those codes that apply to ICRAs. I'm not going to talk about this here. If you have any specific questions about this, again, contact me at the end of this webinar, but we want to spend most of our time going through the other codes. This is a list of those added ICRA codes that we're just going to bypass today. Part 3 of the 1095-C, this only applies to employers that are self-insured. If you have a self-insured or balance-funded plan, you have to provide the IRS with the names of the family members that are also covered under the plan and which months they are covered. If you are fully insured, that section is not completed. This is the slide I was referring to the person that asked the question about an applicable large employer, 50 or more full-time and full-time equivalent employees, under the during the entire prior calendar year that are working 30 or more hours per week. They must be offered coverage to the employee and also to child dependents. The 1095-C is used to enforce this mandate. The 1095-C is largely about a story of the offer of coverage to the employee. The IRS doesn't really care if the employee enrolled or not, but they want to know information about the offer of coverage. The 1095-C assists the IRS to know that the employer met their mandate to offer coverage And it also helps the IRS to determine if the employee is eligible for a premium tax credit on covered California. So to do this, the 1095 answers several questions. Was the employee offered ACA compliant coverage? What was the lowest possible cost for the employee? This is not necessarily what the employee paid, but it's what the lowest possible cost could have been for employee-only coverage. Did the employee enroll? If they waived, was the coverage affordable? And if the employee was not offered coverage, why not? So here are the codes, and these are all of the primary codes. However, note that I have highlighted some of these codes in red. The reason is because these are the primary codes that I would expect to see on a valid 1095-C form. Line 14 gets the Series 1 codes, and line 16 of the form gets the Series 2 codes. And the codes work in combination, like we've already seen. We have code here 1A for the qualifying offer of coverage, which we've talked about. Code 1E is the code most often used by clients of Morrison Garritano because you are offering coverage to the employee, a dependent, and a spouse. And then code 1H, meaning that there was no offer of coverage for that particular month. Then we have our Series 2 codes. So for example, let's talk about 1H, no offer of coverage. 1H could be easily paired with 2A. You're not going to make an offer of coverage to somebody who is not employed by you. However, if I see 1H paired with, say, 2C on a form, I'd have to ask some questions about that, because how can you have no offer of coverage to an employee who's enrolled in coverage? That makes no sense. Those two things can't both be true. Likewise, I sometimes see code 1E paired with 2A when I'm auditing forms. And again, that doesn't make any sense, because how can you have an offer of coverage to an employee who doesn't work for you? So it's in learning the codes and what they mean and what code combinations work and what code combinations make no sense, that help you when you're auditing the forms that are produced by your third-party vendors. I've also included in green the affordability safe harbor codes, and they're in green because they're associated with money. So these are the codes that you would use when employees waive your coverage, but you have to show the IRS that your offer of coverage was affordable because you're using a particular affordability safe harbor. For purposes of time this morning, we are not going to go into a great deal of discussion about the safe harbors. I have a couple slides here on them, but if you have questions about which safe harbor should be used for you, contact me again after this webinar and we'll talk that through. I just want to briefly talk about the codes that I would not want to see on a 1095 because these are penalty generators. 1B, an offer of coverage just to the employee and nobody else. That violates the ACA. Likewise, an offer of coverage to a spouse but not dependents violates the ACA. You're required to offer coverage to the employee and dependents. You're not required to offer coverage to a spouse, but most companies do. 1F is an offer of coverage that does not meet minimal value. That violates the ACA. Excuse me. I also have 1H on this list, and I'm not showing it on this list to show that that it's necessarily wrong, but just that if I see code 1H on a 1095 and it's not properly paired with a code on line 16 that makes sense, or if it doesn't have an affordability safe harbor code, I want to ask questions about why there was no associated line 16 code with 1H. It means either that there truly was an unaffordable offer of coverage, which is a concern, or that there may be an HR data issue with the vendor that's causing the line 16 information to not populate. It's a red flag nonetheless. Here are the affordability safe harbors. FPL is based upon Fed poverty earnings. Rate of pay is based upon a calculation of the employee's hourly rate of pay. W-2 is an option, however, it's more complex, and the one thing that I want to have as a takeaway for W-2 is that W-2 can only be a prospective safe harbor. You're never really going to know if you're using W-2 safe harbor if it's affordable, because you're not going to have that actual data until the end of the tax year. However, for certain industries and certain kinds of situations, W-2 makes more sense. We try to use some science to estimate if W-2 is going to work for a particular situation. And it's also a much more complex calculation, because for an employee that works for you for only part of the year, you have to do a fractional analysis of the W-2 data. Again, if you have questions about which safe harbor you should be choosing for your situation, contact me with those questions. So for the rest of our time together, and I think we're doing pretty good here, I want to go through some actual 1095-C coding examples so you can see what a proper 1095-C looks like and what a improper 1095-C would look like when you're auditing your forms. So here's an example of a valid form. Here's an employee. I think this actually mimics the one that I showed earlier this morning. So here's an employee who was hired sometime in April, full-time. The company's waiting period is first of the month following 60 days. They offer ACA compliant coverage, which is a cost of $125 to the employee for employee only coverage. And the employee takes the coverage and then leaves employment sometime in November. So just like we went through before, this is a valid form. The codes are accurate and they work. They make sense. The combinations make sense. 1H, we know now, means no offer of coverage, and that's valid with 2A, meaning the employee was not employed by the company in those particular months. And as an aside, I should mention the reason why we do this on a month-to-month basis is the penalties are actually assessed on a monthly basis. They're not blanket annual fines. We talk about the fines in terms of what the total would be for the entire year, but the penalties are actually assessed on a month-to-month basis. That's why you have to fill in every single month on your 1095. And that reminds me, one question I sometimes get is, do all 12 months have to be filled in even if the employee didn't work for me? And the answer is yes. I sometimes audit 1095s and only part of the year is filled out. The rest of the year is blank. The entire form for all 12 months has to be filled out. Okay, so back to this form. So now in April, the employee is hired. So we're still using 1H. There's no offer of coverage, but now the reason's changed, and the reason is that the employee is now in your waiting period, which we know is code 2D. This is an entirely valid combination. The employee is now eligible for coverage July 1st. Code 1E is appropriate. 125 is the proper cost. The employee enrolls. 2C, that's a proper code. It works with 1E. And then the employee leaves employment, and now in December, we're back to 1H, no offer of coverage, and 2A, the employee is not employed. Okay, so for the following examples, we're just going to make some assumptions here. We're going to assume that it's a valid ACA offer of coverage. We're going to assume that the waiting period is 60 days. 2022 affordability percentage is 9.61%. FPL earnings for last year were 13,590, and we're going to assume that the employer in this example is using rate of pay safe harbor and pays minimum wage. So here's our example one. The employee is eligible all year, enrolls in coverage at 125. Here's what that form looks like. Super straightforward. There should be no questions about this coding. We're using the all 12 month box because the codes have no change at all for the entire year. And if that's the case, you get to use the all 12 months box, 1E, 125, 2C. Pretty straightforward. Here's the same situation, except the cost of coverage is different. Same form, just different information on line 15. Again, pretty straightforward. Should be no questions about this whatsoever. So here's an example, fairly similar. Cost of coverage for the employee is $120. However, the employee also adds a spouse and a dependent to the plan, and the total cost is now $250. What does this form look like? So this form looks like the other ones where we're populating the cost of coverage for the employee on the form, not what the employee actually paid. The line 15 information only pertains to the employee themselves. It does not apply to costs associated with family coverage. Okay, so here is our next form. Eligible all year cost of coverage is 105 for the employee, and the employee mid-year had a qualifying event and then dropped coverage. So here we see our qualifying offer of coverage code, code 1A, and the reason why it's here is because of the cost of coverage to the employee. 105 is below that FPL number, and so we have 1A on line 14. And now some of you may be questioning, why do we see code 2C on line 16 if you told us that nothing has to be on line 16? So the reason for that is line 16 again is completely optional and is largely blank when you're using qualifying offer method. However, I like to see code 2C in these situations as a visual reference that the employee was actually enrolled. It's not mandatory, it's optional, but I think it's a good visual reference so you can get a sense throughout the entire year, was the employee enrolled or not enrolled? For the rest of the year, note that line 16 is blank because during the months the employee in this situation is not enrolled in coverage, you are not required to provide an affordability safe harbor. Okay. Eligible the entire year, waived coverage that cost $115 for the employee only. Employee had a qualifying event and then added coverage as of July the 1st. And here's this form. 115 is over that FPL number, so we can't use 1A anymore. So now we're back to the standard 1E offer code paired with 115. That's the cost for the entire year. For the first few months, the first 6 months, actually the employee waived coverage. So we're telling the IRS that the coverage was affordable based upon rate of pay safe harbor, which is 2H. And then when the employee did enroll, we are reverting then to the 2C code, the employee enrolled in coverage. We'll go through maybe a couple more of these, and then I'm going to switch to some forms that have some problems and what those problems look like. So here's an employee, again, eligible all year, enrolled in coverage at $50 for employee only. You should be able to kind of predict what this form is going to look like, 1A, 2C for the whole year. This could also be 1A with no 2C, and it's still a totally proper form. Again, the 2C is optional, but I like to see it for auditing purposes as a visual reference. Eligible all year, waived coverage, 175. Qualifying event coverage came on as of March the 1st. Same situation with qualifying offer of coverage, 1A, all 12 months, and then 2C starts up as of March. But again, this could be a totally valid form with that 1A code in the all 12 months box and nothing else on the form. Okay, there are several more of these examples of proper 1095s that you can take a look at. The answers to the questions will be on the presentation that you'll get. I'll just talk about this one because this is actually sort of one of the more common scenarios that you'll see if you have somebody that's been hired mid-year. So this particular employee is hired on April the 12th. Cost of coverage is $125, and they enroll in coverage. So again, for the first 3 months, we see 1H, which means no offer of coverage, paired with 2A, the employee was not employed, totally valid combination. And then as of April, the employee is now working for you, they're hired, they're an employee, but they're still not receiving an offer of coverage because they're in the waiting period. So it's still 1H, but now the reason has changed. And the reason is now code 2D, they're in your waiting period. July 1st, they come on the insurance, the code reverts to 1E. 125 is the cost for just the employee, even if they add family, and code 2C, the employee is enrolled. And then that's the same condition for the rest of the year. Okay, so let's move to a couple of the situations where there are problems. And forgive the vertigo on the slides moving. Here we go. Okay. So this is a very, very common problem that I see when I'm auditing 1095s produced by third-party vendors, 1H all the way across the board. And the code combinations may be totally accurate, may be totally true. 1H paired with 2A, no, the employee wasn't employed by you, totally valid. 1H paired with 2D, the employee was in a waiting period, totally valid. And again, from August through December, 1H paired with 2A. Again, that can be totally correct and valid based upon the HR circumstances. However, ineligible employees do not receive 1095s. So if you ever see your 1095s with 1H all the way across the board for the entire year, you need to alert your vendor not to send this form because this is an ineligible employee. I have seen the IRS propose penalties on employers on ineligible employees because they allowed forms like this to be sent to the IRS. So be watchful of this. Here's another common mistake I see, the misuse of code 1A. 1A, the qualifying offer method code, is strictly tied to the cost of coverage. The cost of coverage must be below that FPL number. If it's not, 1A cannot be used. So this form would be in error. Here's another inaccurate form. The first few months are fine, 1H paired with 2A and paired with 2D, those are valid. But then look what happens in June. We have 1H, no offer of coverage paired with code 2C. How can you have no offer of coverage to an employee that is enrolled in your coverage? That doesn't make any sense. Those two things can't be true. These kinds of errors come up quite often, and they're typically the result of inaccurate HR data information, either in your payroll system or in your Ben admin system. So you would want to go back and diagnose if there has been some sort of a data entry issue. Here's another form with similar problems. The 1H 2A and 1H 2D in the first few months is totally valid. These combinations work. But then look what happens again in the subsequent months. We have 1H paired with 2C. We know now that those two things cannot be true. And 1E, offer of coverage paired with 2A, employee not employed. Again, that's an invalid combination of codes. You cannot have an offer of coverage to someone that does not work for you. This code combination makes no sense, and this should cause you to go back and re-examine your HR data. So I have several examples of these forms where there are issues with the coding. Again, go through these examples on the full presentation. And we are right on time with our 45 minutes. And I think, Sarah, this would be a good time for our last poll question. We did the second poll question, right?
We did not actually. We can do that one right now if you prefer.
Let's do both of them right now. Yeah, so
Okay.
let's pull up our second poll question, which I think has to do with if you have copies of your 2021. Yeah, so do you currently have copies of your 2021 ACA forms in your possession for audit or penalty defense purposes, yes or no?
I'll give it a few more seconds here. All right, you should see them now.
Again, great to see these numbers, 93%, that's fantastic. Yeah, you want to have copies of this stuff saved locally, pulled off of your vendor's website. Um, and the one thing I note about this, any of you that are using Employee Navigator, for example, they only maintain the last 3 years of information on their site. So if you haven't pulled stuff down, you may try to get older years and you simply can't get it because it's not there anymore. And then we have one last poll question for you.
Yep.
Are you aware that Morrison Garritano provides free ACA reporting auditing service? I hope I hope we see 100% answers, Sarah, to
It,
this
it,
question.
it's it's close, but this
It
is a
is
good
close.
educational opportunity.
Okay, it's close. It's not as close as I had hoped for, but it's close. Yeah, so
But they're here, so
they're here. So please know that part of my job, part of the reason why I exist and do this for a living is that I help you guys with this stuff. So please utilize me to review what's being produced by your payroll vendors, by your third-party vendors. I encourage any applicable large employer that's a client of M&G to have me audit your ACA stuff before it gets transmitted. I'll tell you that virtually every batch of forms that I review, I find issues. So please take advantage of it. It's no cost. It doesn't take very long, and it's better to have a second pair of eyes on that stuff before it gets to the IRS so that you avoid being part of that $2.1 million club, which we don't want. So in closing, and then we'll take a few questions, um, just be aware that the ACA is fully intent on collecting ACA penalties. I still get asked every so often, do we still have to do these reports? Are they going to go away soon? No, they are here permanently. They're here for good. They're not going away. Make sure your ACA reporting is accurate and timely. Again, you have me as a resource to help you with that. And even if you have vendors doing this for you, remember the liabilities are on the employer, not the vendor. The vendors are not reviewing the information. They're simply processing the forms for you. It's incumbent on you as the liable employer to know what the codes are, what they mean, and be able to self-audit these forms for yourself. Again, I've harped on this, but you've got to audit everything. No third-party vendor should be allowed to transmit anything to the IRS unless somebody has put eyes on it first. Keep copies of everything so you can defend yourself, and again, take advantage of the free service you have through my office. So that's our presentation. Thank you so much. I know it was fast, but again, you'll have the full slides, and then you have me to call or email if you have any questions about stuff that we blew over pretty quickly. We have set aside time at the end of this for questions, so I'm happy to open it up at this point and take any closing questions that anybody has about anything we talked about this morning.
nothing's coming in, Keith. I think you may have done a really thorough job.
Wow, okay. All right, well, again, in that case, we're going to give you back some time to your morning. Again, thanks so much for being here. I hope it was helpful. Happy New Year to everybody, and we'll see you next time.